Hello. Welcome back, friends, to Alpha Beta Soup. I'm TXMC. Well, it's been about a week since we spoke last, maybe a little bit longer. We've got a few things to talk about from the markets over the last few days. We'll touch on interest rates, we'll touch on the CPI and the market's reaction to it, the FOMC upcoming this week, and how all of it ties together. I'll try to paint a cohesive picture for you, but I will be honest, these markets are getting harder and harder to read. But we're at a critical place and we've got a few things to discuss, so don't go anywhere. If you enjoy my content, make sure to give this video a thumbs up, subscribe to my channel, and share it with all your friends. Your support helps drive the success of this channel, and I can't thank you enough for making me a part of your day. I noticed in editing that my voice has a little bit of an echo today. Apologies for that. Not sure what's going on. I'll try to have it figured out for the next video. Now let's get into it. Well, it's FOMC week, friends, and it's a big one. You know, we've had a year full of impactful weeks. It feels like every few days, some news story comes out that moves the markets in a big way. So when I say that this is an important week, I don't say it lightly. It's big for a couple of reasons. The first, we do have FOMC on Wednesday, where we find out what the next interest rate hike is going to be. It's our first one since July. The market believes with an 86% likelihood as of right this moment that we will get a 75 basis point hike again, just like we got in July. It gives a smaller chance to a 100 bip hike, but it's probably going to be 75. And that's where I line up as well. I think it will stay at 75. If we look at the history of hikes this year, we got the 25 in March, in early May we got the 50, and then we've got back-to-back 75 basis point hikes. And when you think about this factor here, the aggressiveness of rate changes is a derivative of this saga itself. So the pace at which they raise rates and whether they choose to go higher, lower, or stay at the same pace, that has a signal to it. I do not believe that they want to raise the pace up to 100 basis points right now. I think that 75 is still plenty aggressive. It still helps them get to their ultimate goal of being at 4% or higher by the end of the year, if that's what they're going to hold to. And if they were to suddenly jump up to 100 basis points, that would change the tenor of the conversation. The conversation would become, wow, the Fed is suddenly becoming more aggressive. They're becoming more hawkish. They're raising even higher than they have before. And I just don't think that that is the kind of narrative the Fed's trying to engineer here. The market already appears kind of weak, and they've raised 225 basis points in less than a year. That's extremely aggressive. So I anticipate they will stick with the same pace they've had for the last two meetings. We'll get another 75, and they'll talk about data dependence, queuing us up for probably seeing a 50 in November if I had to guess. But that is for another conversation. The market thinks we'll get 75. I think we'll get 75. And you know, I do think that last week was a bit of an overreaction by the market to the CPI print that came in on Tuesday. It came in just a hair higher than the market was expecting. CPI rose in August 0.1% month over month. And I think that the market was expecting a negative 0.1%. So that small fluctuation caused an extreme move in price. If we go look at that extreme move on a 1-minute candle, you can see that it happened mostly all at once. This is when the CPI report dropped last Tuesday, at the exact moment. And in that time, we saw a huge flush down. This is on the Dow Jones. There was a 640 point move on the Dow Jones in a single minute. That is insane. That almost never happens. And you can even see it on a 15-second chart where each one of these candles is 15 seconds. The whole move took place over 4 of these candles. And this, friends, is algos. These are bots making decisions. These are not humans panic selling. This is a repositioning by a bunch of different funds and algo traders based on the number that came out on the CPI report. They thought it would be a negative and it was a positive. Even though it was only a positive by a hair, by a nose hair, it still produced this oversized reaction. And so what does that produce? But a major 3 sigma daily move on equities, which is extremely rare. And it's the first one that we've seen all year here on the Dow Jones. And I want to talk about what happened inside of that CPI report. So I think that the market anticipated that we would get a negative month-over-month CPI change because of what's going on with energy prices. So we see the breakdown in oil here happening over the last few weeks, but once it broke down below $90, you really started to see the market softening on its idea that maybe oil is going to capitulate even though we have shortages of supply, even though we have an energy crisis. Perhaps we're seeing enough demand destruction that oil actually breaks down. And likewise, gasoline prices have been falling. These are gasoline futures. They're now down below $2.50. I think a lot of this drove the anticipation that we would have less of a CPI print than we got. So when you look inside of the basket and you break out the various pieces of the CPI and you look at them month over month, the market was right, but they weren't correct about the outcome. So you can look inside of here. There are two parts of the CPI that went down significantly from July to August, and they relate to energy. Energy is the biggest piece, down 5%. Airline fares down 4.6% month over month, highly dependent upon energy prices. So the market was correct about energy. It saw the breakdown of gasoline, the breakdown of oil. It correctly anticipated that that would have a deflationary effect on CPI. However, the rest of the basket saw broad gains. Virtually everything else, with a couple of small exceptions, saw broad CPI gains last month. So that print that we got that was essentially flat from one month to the next happened because energy went down bigly while everything else went up just enough to negate it. And the thing that I think really surprised the market was the jump in core inflation. Core is the part of the CPI basket that excludes energy and food. So when you take those pieces out, you're left with a more stable and less volatile mixture of goods and services that usually don't jump around quite as much. But we saw more than a 0.5 percentage point increase in core CPI month over month, led largely by rises in rent, which fits into this shelter category here. But broadly, we're still seeing stubborn prices across the consumer basket. And while energy is coming down pretty swiftly, it's no guarantee that it will be enough to soften these CPI prints. And something that adds a little cherry on top of this mess that we're dealing with the CPI, with the FOMC this week, September is almost always a bad month for equities. What you're looking at right now is the average monthly performance of each month of the year going all the way back to 1896 on the Dow Jones. About 130 years of data on here. And what do you see? September is far and away the worst month for performance out of all of the months. It's got an average of -1%, and there's no other month that even comes close in terms of negative performance. So we've got some historical headwinds working on us already, in addition to the mess with CPI, things that are going on in the FX markets with the dollar being too strong. All that stuff is just adding on to this history here, which is not very kind. This is a look at the 2-year Treasury yield and the Fed funds rate, which is in red. Now, we've talked about on this channel quite a few times how in all prior hiking cycles, the last interest rate hike came once the 2-year yield crossed the federal funds rate. And so over the last few weeks, we've really been observing the 2-year Treasury in this 3% to 3.2% range, trying to see if it could break above that. And for the longest time, it was not able to. The market was struggling to price itself in the range that the Fed insisted it wanted to get to. Well, that has started to break down and reverse. And now we're seeing yields climbing higher. And just since the last time we really took a look at this chart, the 2-year yield has jumped almost a full percentage point since back here in the middle, late July weeks. That's a massive move in a very short period of time. And what it does is it creates more potential runway, and it's suggesting that maybe we're not actually at the end of this hiking cycle yet. As inexplicable as it may seem, when we look at record debt levels, we see the havoc it's performing on the Treasury markets. We see economic weakness everywhere. People are wondering, can they really continue to raise rates in this environment? And they absolutely can. They're proving that they can. It's up to the market to tolerate those conditions. And so far, it has been more resilient than myself and many others anticipated it would be. This has been a slow-moving train wreck. And it seems like the train wreck now has a little more room to play out here. And it's not just the 2-year. If you look out across the Treasury curve, all of the different instruments have now broken their June peaks. Here's the 2-year ripping past it, the 3-year, the 5-year, the 7-year. Now the 10-year right here, it had been stubborn. It had been holding out, but over the last couple of hours, it finally broke over 3.5%. That was the first time that it had printed 3.5% since 2011. And now every Treasury across the curve is creating new highs. And I think that this will continue to catch people off guard. We had people calling the peak of yields in June when everything blew out. Those people have been proven wrong. We also had people say that we were going to start a new bull market as soon as yields peaked. Those people were proven wrong down here when the market reversed. And I think that what happens over the next few months is probably not in anyone's base case. It seems inexplicable that they're able to continue to raise rates, but they've been able to. It's more about the market's ability to digest the rate hikes than it is about the rates themselves. They could raise interest rates to any number they want to, but the reaction function is what we all care about. But when I look at what's happening here, particularly on the 2-year, giving the Fed much more room to operate, when I see all these Treasury yields breaking into new highs, when I see 10-year real yields, which are inflation-adjusted 10-year yields, back over 1%. All of these are major headwinds for growth. They are not conducive to risk performing well in these environments. A 1% real yield is not something the market wants to see at this current juncture with such economic weakness, because what this does is it makes Treasuries more appealing than risk assets. It pulls capital away from speculation. And the last time that we had real yields of 1%, this is when Powell pivoted at the beginning of 2019, and he began talking about being more sensitive to economic data and less hell-bent on raising interest rates. That came back here. That was the last time real yields were at 1%. But the difference is that now there's not any sign that Powell's about to do that. So we could be in for quite a bit more roller coaster ride before we get to that kind of position. So taking into consideration what's happening with the 2-year, what's happening with all Treasuries, considering that we have an FOMC meeting this week, we're seeing all this different economic data continuing to deteriorate month on month, and we see all these markets sitting at critical high time frame support. This feels like a big week. And, I put pressure on myself to come on here onto this channel and provide you guys with insights, to give you something when you walk away from my videos. I want you to know what I'm thinking about, but also my goal is for you to have something that you can take away, something to digest, to work on in your mind, maybe gives you an advantage over the average person in these markets. And lately, it's been really hard to do that. My videos have been more spaced out. I really struggle with what to talk about because there's a part of me that doesn't want to just come on here and be a doomer permabear, because I'm bullish on Bitcoin long term. I'm bullish on human ingenuity and survival long term. I don't think that we're at the end times, but fractally and economically, the markets look like shit, and they are in store for more pain if they're not able to maintain their structural integrity at these current levels. So as we sit here in this week where we've got a big interest rate decision coming up, we see what's been going on over here in these Treasury markets with yields all breaking out to new highs. And CPI last month remained stubbornly elevated across the basket, with the lone exception being energy. I just find it very difficult to have any kind of conviction or clarity of thought about the near term. And it makes it difficult to convey to you guys what to think about and what to be focused on. And I'm really sharing all of this with you so that you can better understand where I'm coming from, so you can know what goes through my mind as I'm creating this content for you, because it's not as simple as me sitting down, pulling up my most recent charts and just flapping my gums for 20 minutes. I want to have a cohesive idea. I want to put these things together in a way that makes sense, and I want you to feel like you didn't waste 20 minutes listening to me ramble. And lately, bringing that value to you has been a significant challenge, and we're reaching an apex here where we're standing on the top of the knife, and depending on the direction we're able to hold could mean mean something significant. So I implore upon you to maintain your patience and your rationality in these times, because this sequence of events, this saga that we are dealing with, can play out over a much longer time frame than anyone is prepared for. And likewise, I think that if these levels begin to break down and the market starts falling lower on a market-wide basis, I don't just mean Bitcoin, if all markets broadly begin breaking down further from these levels, I think that the downside move and the time that it will take to recover is beyond anything that traders that have come up post Great Financial Crisis are prepared for. It won't fit any of your prior experience. We're already seeing interest rates that don't match your prior experience. So being humble, being patient, holding on to your humility at times like this are key to your survival. So we'll watch this week and we'll see if the market was correct, that we get a 75 basis point hike, which is what I anticipate, because I don't think that they want to change the narrative around their pace of aggression at this time. I think they want to hold the line, and we'll find out on Wednesday. Make sure that you follow me on Twitter at TXMC Trades. This is where a lot of my thoughts and analysis goes, and it's the primary place to get in touch with me. I did announce in my last episode that I launched a premium newsletter. This is my attempt to write out more long-form ideas, have a new medium by which to express myself, and if I am fortunate enough to earn your subscription, perhaps a way that I can turn this work into a full-time career. I gotta start somewhere, and this is my best attempt. So I appreciate you considering signing up for the newsletter. There's a link in the description below, or you can see my pinned tweet on Twitter. And that is where we will leave things today, friends. We talked about interest rates. We talked about the changes to the CPI, particularly the stickiness of some of the core aspects that tie back to what happens with rent prices from our inflation video a couple of weeks ago. We'll see what happens at FOMC. I expect we'll get 75 bips, and the press conference afterward is always must-watch television in the Powell era. We'll give these markets a few days to play out, and I'll make another video at the end of this week or beginning of next week. After I put this video out today, I will be wrapping up issue number 2 of my newsletter, which I expect to be out in the next day or two. But all right, I've been rambling for a while. I'll let you guys get back to your Monday. So until the next time that we talk, take care of yourselves, friends. Take care of your families. Get outside and touch some grass. Try not to spend too much time listening to the mainstream media, and you and I will chat again in the very near future. Cheers, everyone.